Hi, I'm Matt Armstrong, a financial advisor at Savant Capital Management. I'm here to welcome you to Savant Backstage, a video series that will give you a behind-the-scenes look at what we do. Our goal with this series is to help you build your ideal future by providing you with tools and information to help you become a more informed investor. Today's topic is building better portfolios. It's a high-level overview of the strategies we use to construct portfolios. And now your host, Gina Beal.
Hello, I'm Gina Beal, and I'm a member of Savant's Investment Committee and Research Team. I'm going to walk you through an introductory overview of how we build better portfolios. Let's start with the thought that most investors want to capture the best possible return for a given level of risk. Well, Savant does too, and research has proven time and time again that the asset allocation decision is the key driver behind the variability in portfolio performance. In fact, the results of an academic study shown here supports the statement that allocation decisions account for over 90% of the variability in returns earned by investors. An investor's ability to pick the right stocks and time the markets accounts for only 5% and 2% respectively. In other words, the things that everyone pays the most attention to have hardly anything to do with the investment results. That's why we focus our research on determining the best possible asset allocation. What do we mean by asset allocation? It's the strategic combination of asset classes, such as stocks, bonds, and cash, in a portfolio to reap the highest long-term returns given an investor's acceptable level of risk. One of the main jobs of the Savant Investment Committee is to build a set of investment models which diversify the assets as much as possible, given the targeted risk levels. I'm going to briefly show you how we do that by showing you a basic portfolio from which we layer on 5 diversification strategies to arrive at a portfolio with better returns and similar risk. This is a plain vanilla, do-it-yourself portfolio of 70% S&P 500 large-cap U.S. stocks and 30% short and intermediate maturity treasuries. Historically, from 1973 to 2012, this portfolio earned 9.2% on average per year, with volatility level of 11.2%. That sounds pretty good, but it can be better. So let's discuss how the 5 diversification strategies can improve the outcome. Step 1, a defensive bond strategy. Bonds always have been a means of protecting principal and providing income. However, it's not enough to simply invest in bonds today. It's imperative to understand exactly what types of bonds are needed to protect and diversify the assets. As such, you need to go beyond U.S. Treasuries and incorporate a wide range of high-quality bonds, such as corporate bonds, mortgage-backed securities, inflation-protected securities, and foreign bonds. Step 2, invest globally. With over half of the world's wealth located outside the U.S., we simply cannot ignore these international investment opportunities in both developed and emerging markets. Many of these non-U.S. companies are industry leaders. Step 3, own some small-cap stocks. Using a nature analogy, all trees start out small and carry a higher risk of not surviving. Similarly, companies start out small and carry higher risks. But for those willing to take on that higher risk, the reward or payoff makes it worthwhile over the long run. Of course, you need to invest in thousands of small stocks so as to not rely on the fate of one company. Step 4, tilt toward value stocks. Value stocks are described as stocks on sale, while growth stocks are the glamour stocks. To tilt toward value stocks, you should focus on stocks on sale rather than pay a lot for companies that may or may not pay off. Both history and evidence vindicate the value investor over the growth investor. And lastly, step 5, incorporate alternative investments. Adding investments such as commodities and REITs that have lower correlation with other parts of the portfolio can reduce risk and potentially add return. So let's take a look at how all this comes together in this last image. Evidence clearly shows additional return can be generated by implementing a broad, globally diversified portfolio over a basic portfolio. The basic portfolio, Portfolio 1, earned a 9.2% return on average. But factoring in the 5 diversification strategies, the historical return went up by 2.2% per year, as shown by Portfolio 6. It might not sound like a lot in percentage terms, but when applying this to the dollar value of a portfolio, it could be a life-changing difference in wealth. That concludes our overview of building better portfolios. Thanks for watching this first segment. Please be sure to check back in for the next segment in this series. If you have questions or would like more details on this topic, please contact us by emailing your questions to info@savantcapital.com or by visiting our website at www.savantcapital.com/EBI, where you can download a copy of our evidence-based investing white paper. You can also call us at 866-489-0500 to request a free copy of that white paper.